and it's time for another Macro Monday, where I get you ready for the week ahead in 5 minutes or less. Just a reminder, as always, this is just a small snippet of our full Macro Monday newsletter. So if you're looking for more in-depth coverage on the week ahead, I highly encourage you check out the link I'm going to put in the description of this video. I think you'll really enjoy the full version of this newsletter. Okay, so as always, next up is our chart of the week. And given the ongoing government shutdown, as you'll see on the next slide, this will be another relatively light week on the data front. However, we do get several key releases from independent organizations this week, and that's something to pay attention to. The NFIB report for October is due on Tuesday, and that should offer valuable insights into labor markets, earnings trends, and capex intentions from the perspective of small businesses. We use the NFIB a lot in our work, and especially right now when we aren't getting all of the data we're used to from the government. And then on Thursday, we'll see the NAHB Index, which we often consider the PMI of home builders. Historically, trends in the NAHB tend to lead several key economic indicators, including initial jobless claims. Based on that relationship, current readings suggest that claims should remain soft in the coming months. Any improvement in the NAHB would be an encouraging signal in support of the economic recovery narrative. And so that brings us to the chart itself. Now, assuming something isn't done regarding the government shutdown by Thursday, it seems unlikely we will get claims reported. However, we can use relationships like these, the NAHB, with claims, sort of project where things might be headed. And right now, it's not very encouraging. And now, in terms of this week's data, as I mentioned, a lot of this is going to be repeat because there just isn't that much to talk about, because half of the series here probably won't get released. With the government releases still suspended, attention will turn to the NFIB Small Business Survey out Tuesday morning, as I mentioned on the previous slide. The optimism component of this report tracks closely with small cap earnings, and last month's results were strong across the board. Here I have a quote from the NFIB chief economist, Bill Dunkelberg. Optimism increased slightly in August, with more owners reporting stronger sales expectations and improved earnings. Labor quality remains a persistent challenge for small firms, and that is thus far consistent with our theme of an inflationary U.S. recovery. Speaking of that, this week should help further define that recovery's trajectory, beginning with our first look at October data via the Empire Fed Index on Wednesday at 8:30 a.m. We're also supposed to get the Philly Fed, as you can see, on Thursday. However, according to their website, they said they may suspend the publication due to the shutdown. Both of these, hopefully we do get the Philly Fed, but both of these are useful regional gauges of manufacturing activity that will help round out the macro picture. And September readings for both of these regional PMIs softened modestly month over month, but have generally trended higher this year, mirroring the ISM Manufacturing Index. And then finally, again, as mentioned, there's just not that much to talk about with this data. We'll also get the NAHB Housing Market Index, a series that has been in the doldrums for some time. We expect another subpar October reading, though on a rate of change basis, the index may be starting to trough and show early signs of life out of its low 30s range. A rebound in housing would mark one of the earliest signs of a cyclical recovery. Still, for housing fundamentals to improve meaningfully, survey data suggests mortgage rates would need to fall by 200 basis points or more from current levels. Unfortunately, with numerous inflationary catalysts on the horizon, we do not believe that that big of a drop in mortgage rates currently represents the base case. So we're going to need a lot more Fed rate cuts to get mortgages in a place where we see housing fundamentals improve. And that's what we'll leave you here today. Again, with this government shutdown, we aren't getting the same volume of data that we're used to, but we're going to make do with the independent data sources that we have and apply those relationships to some of the series that we're not getting, try to fill in some of the pieces of the puzzle. We'll be posting about some of that on LinkedIn this week. Thanks for watching. I hope you have a great week. Don't forget to subscribe to this YouTube channel if you enjoyed the video, and I will see you right back here next week for another Macro Monday. Bye, everyone.